commensurate expansion of the market's access to term repos from the Reserve Bank. The primary objective is to improve the transmission of policy impulses across the interest rate spectrum. Let me now turn to developmental and regulatory policies. We have set out a 5-pillar framework to guide the developmental and regulatory policies of the Reserve Bank. I invite you all to go through Part B of the policy statement, which lays out the developmental and regulatory measures, the progress made, and some new initiatives that are being undertaken. Let me highlight a few. Some recommendations of the Dr. Urjit Patel Committee report have been implemented, including the adoption of the new CPI combined as a key measure of inflation, explicit recognition of the glide path for disinflation, a transition to a bi-monthly monetary policy cycle, of which this is the first, progressive reduction in access to overnight liquidity under the LAF at the fixed repo rate, and a corresponding increase in access to liquidity through term repos, and the introduction of longer-term term repos as well as going forward term reverse repos. Following on the recommendations of the High-Level Advisory Committee chaired by Dr. Bimal Jalan, and after consulting the Election Commission, the RBI will announce in-principle approval for new bank licenses. Immediately after, and using the learning from the licensing exercise, as well as building on its previously released discussion paper on banking structure, the Reserve Bank will work to give more licenses more regularly, that is, virtually on tap. It will also set out categories of differentiated bank licenses that will allow a wider pool of entrants into banking. Turning to markets, to expand investor demand for inflation-indexed bonds, design changes improving their attractiveness to the general public are being worked out. In order to expand the market for corporate bonds, banks will be allowed to offer partial credit enhancements to them. The feasibility of limited re-repo or rehypothecation of repoed government securities is being explored. As regards foreign investors, the Reserve Bank welcomes them and will continue to work to ease entry costs while reducing risks for investors and the volatility of flows. Towards this end, modalities allowing foreign portfolio investors to hedge their currency risks through exchange-traded currency futures are being worked out in consultation with SEBI. FPIs will also be allowed to hedge their coupon receipts falling due during the next 12 months. KYC norms are being simplified for foreign portfolio investors. To encourage longer-term flows and reduce volatility, FPI investments in G-SECs will henceforth be permitted only in dated securities of maturity 1 year and above, and existing investments in T-bills will be allowed to taper off on maturity/sale. Any investment limits vacated at the shorter end will, however, be available at longer maturities, so overall FPI limits will not be diminished. Turning to the inclusion and customer protection agenda, we intend to enlarge the banking correspondent base through the inclusion of new entities as well as considering a relaxation of existing distance restrictions. A number of measures to protect consumers are being envisaged. For example, banks should not levy penal charges for non-maintenance of minimum balances in ordinary savings banks accounts and on inoperative accounts, but instead they should curtail the services accorded to those accounts until the balance is restored. Finally, and last but not least, to tackle distress in the system, the comprehensive framework we outlined to help banks reduce their NPAs, even while putting distressed projects back on track, will be effective from today. We will monitor progress and make any needed adjustments to ensure it operates smoothly. I hope that the only thing that was surprising about monetary policy today was a lack of surprise. I'm glad financial markets and analysts have started understanding what we are doing. Thank you very much for your attention.
We'll take 2 minutes for photographers to clear the room, please, and the media to get in. Shaima, you can make your announcements in the meanwhile.
Sure, ma'am. Participants connected to the audio press.
All right, we'll get back to that in just a bit, but as he said, the only thing surprising is the lack of surprise this time around. So completely unchanged in terms of policy, but lots of important statements made as well. He did say that if inflation continues to recede further, then further policy tightening may not be required going ahead. But he is also quite concerned about the way vegetable prices are moving, etc. Also on growth, the growth concerns remain significant. Sub 5% GDP, structural issues continue to persist. So there is still one eye on growth and the concerns that lie over there. The other important statement he made was that KYC norms have been simplified for foreign investors, so that perhaps has one eye on the foreign flows too.
Indeed. Let's get some reaction if we have the two bankers with us. Mr. Rajan, what's your call? How would you rate the body language? Hawkish, dovish, neutral? What's the stance?
I think it is more or less what we expected. I think the governor is data and the Reserve Bank is data driven. We all expected from the data that there would be no change, and indeed there is no change. And therefore, I don't read anything into it. He will, again, going forward again, I would say that he will also wait for data. He says that there is, a threat to inflation, and there may well be. But I think sitting here today on the 1st of April, we can't predict what it's going to be 2 or 3 or 4 months down the line. We will wait for data, food production, vegetable prices, so on and so forth. What is the net effect of the El Nino factor, if any? So I think, sitting here, I would hesitate to make any prediction, and I suspect that the Reserve Bank would also hesitate to make any prediction. They will wait and see what the data actually says.
All right, so the tone of the governor was exactly the same compared to what we saw in the last policy. Mr. Pradeep Kumar, come in on this. Do you as well believe that it's sort of a non-event policy? The tone is very similar to what we saw last time, and he will continue to be data-driven?
Yeah, I think he'll continue to be data-driven. The concern about El Nino and the political uncertainty, the fiscal policies of the new government, I think these are all variables on which he has no data now. So he is not able to take a call on that. So that is why
Mr. Pradeep Kumar, I'll just have to interrupt there. I think the question answers have started. Let's cut across.
In the later government auctions. As well, you have said that you have seen potential output fall very sharply. From what to what?
To your first question, I think the intent is to provide sufficient liquidity to the markets. That means both short-term liquidity consistent with maintaining the call money rate close to the policy rate, and second, providing long-term increases in the balance sheet of the RBI consistent with what we believe is the appropriate rate of growth of credit in the economy.